We are back. Welcome back to the I Love Annuities podcast. I am Jeremiah Conger.
And I am Zachary Van Ness. Together we are the Annuity
Annuity
Dudes.
Dudes. Today's episode is extra special, especially for me. We're diving deep into a crucial topic that's on the minds of many retirees and pre-retirees out there, and that is the topic of long-term care planning using annuities.
Yeah, today we are not alone. If you're watching, you can see we've got somebody joining us. We brought in a true subject matter expert, whereas we're diving into those long-term care planning and looking at annuities for that opportunity. We welcome in Matt Sluizer. He is our senior annuity advisor, and within our company, within Annuity Association, he's our subject matter expert for long-term care planning. So I want to introduce Matt to everybody, all of our viewers and listeners.
Hey, everybody. Thrilled to be here. This is such an important topic, and I'm really excited to shed some light on how annuities can be used as a tool for long-term care planning.
Yeah, so let's set the stage here. Matt and I go back a long time. We actually were college roommates a long time ago, many moons ago, and he is a true expert, a true professional, someone that I would tout as one of the most intelligent individuals that I've ever had the pleasure of knowing. So I'm really thrilled to have him on this episode. I know that he's going to add a ton of value. Before we delve into the specific subject matter here, Matt, would you mind really kind of giving just a brief introduction of yourself and kind of some of your background so that the audience here can get to know you a little bit more in depth?
Yeah, absolutely. So I've born and raised in Florida, been here my whole life. My background went to Florida State, go Noles, and studied accounting and finance. And I've been in financial services my whole career. So I started off at Morgan Stanley as a financial advisor, and I was over at JP Morgan. I worked in banking and lending, and then I really started to explore my accounting background. So I started working for a company that's the largest property management company in North America, and I served as their regional director of accounting and did that for quite some time. And then Jeremiah, as you know, you were sharing with me what you're doing here at Annuity Association. I really missed working individually one-on-one with people and helping them to plan out how to have a successful retirement, with a relaxed retirement, and manage their finances through that phase in their life. And so we've been working together here for some time, and it's really been fulfilling. I'm married, been with my wife now we just came up on 20 years and have a 6-year-old daughter, Madeline. She's wonderful. So I'm still here just south of Tampa.
Awesome, man.
Well, one thing I want to add here. So as well as Matt and I think we know Jeremiah, we did not get the memo on the shirt. We are so left out here. It's unreal.
Well, I was feeling the Jamaican vibes today that goes along with our intro music. So I figured, why not?
Love it. Love it, man.
Yeah. I know the shirt's a little loud, but hey, man, we got to stand out somehow.
That's right.
So anyways, well, thank you, Matt, for the information. I'm sure that helps the audience get to know you a bit more, and really happy and honored to have you not only on this episode, but as part of our organization. You add immense value every day. You go above and beyond for your clients. And since you've joined, you've just helped, set the bar every month and every year to a higher level. Zach, you do the same thing. So I think with all of us here, we're all about sharing the appropriate way to apply annuities to someone's retirement plan. It's about bringing the education and transparency to this antiquated industry. That's something that we're very passionate about. So really thrilled to have two of my best friends doing this alongside me. So, with that being said, let's go ahead and get this started. So Matt, in terms of planning for long-term care and it being such a critical part of retirement planning today, why do you feel like someone should have a plan for long-term care, and maybe why, if they're not, why should they?
Yeah, that's a great question, Jeremiah. So it's an area that I've found from experience that maybe some people downplay, and there are those out there that don't have a plan. But the reality is that 7 out of 10 people over the age of 65 will need some form of long-term care. That's whether it's in-home care, assisted living, or a nursing home. And the costs can be huge, sometimes exceeding $100,000 a year. So if there's not a plan in place, those expenses could devastate a whole lifetime of savings.
Yeah, I know from my end of it, talking with some clients that I've worked with in the past and current clients now, is that traditional long-term care insurance can often be, whether it's expensive. I know one of the clients his cost out of pocket went up from $300 a month to $1,000 a month. It can also be tricky to qualify for. Have you experienced that as well?
Oh, absolutely. So the premiums can be high, the underwriting can be strict, so sometimes it can be tough to qualify. And if you don't use it, oftentimes that money that you paid in is essentially lost. So that's really where there's different vehicles out there, such as an annuity with an enhanced income benefit, that can come into play and assist in that planning. And annuities can offer a guaranteed income stream and an enhanced payout if you have a long-term care need without the use it or lose it downside.
I think that's really, that's really, in my opinion, the biggest benefit there is traditionally, like you guys mentioned, the traditional form of long-term care insurance, it is a use it or lose it type of vehicle. And knowing that there are annuities out there that you can leverage in multiple facets to secure guaranteed income streams in retirement, but also have them benefit you if or when you need long-term care coverage. I think that's huge because, you have those added, you have an added like flexibility aspect to that picture now. So you know that, hey, we've got this annuity that we're using for our retirement income, but we also can benefit from it if we have a need for long-term care. So it's just giving you some more peace of mind, right? And clarity that that principal and that money that you invested in that annuity is not going to waste. It's securing you in multiple ways and almost in multiple phases of your retirement. The first phase being guaranteed income for your lifestyle expenses, and then secondarily down the road, if or when you have a need for long-term care. And knowing that you're having those things secured, I think just gives you so much more peace of mind. And that's really, in my opinion, where annuities optimize the most, is the peace of mind and the clarity. So let's go ahead and take a look at some of these annuities that are going to help enhance these benefits for long-term care. The first is going to be the fixed indexed annuity. These can commonly come with an enhanced income rider that is essentially part of the baseline income rider that will help enhance the income if you do have a need and qualify for long-term care. So, Matt, would you mind helping our audience today break those down and how they work?
Yes, so fixed index annuities are a really popular choice because it combines market linked growth in the account with downside protection, and you can have a guaranteed lifetime income rider with that. And many of the leading carriers offer an enhanced income rider or a long-term care multiplier. And essentially, here's how it works. You invest a lump sum into a fixed indexed annuity with a lifetime income. And if you ever have a qualifying care need, the income from that annuity could be up to double for a set period of time, as far as double what the base lifetime income amount is. And usually that can be up to 5 years where you receive that enhanced payment, as long as you still have that care need. But if you don't have the long-term care need, then you still just receive your regular lifetime income payments. it gives you flexibility in a tax advantage way to plan for the unexpected.
Awesome. Yeah. So, I mean, an example that I've run into where some questions will come up around that as well. We're looking at those products. One thing that we've talked about before is utilizing that 5-point annuity inspection, which we've talked about in previous episodes. But is that an important factor when making the right decision for someone's income annuity? And we consider that. And from looking at that perspective, do you have any key examples that you could reference?
Yeah, so as far as how it would work, let's say that you purchase a fixed index annuity and it is paying a guaranteed lifetime income of, say, $25,000 a year. If you qualify for the long-term care benefit, that payout could increase to $50,000 a year, usually up to 5 years. And so while you're receiving that enhanced payout, it's helping you to cover those long-term care costs from the assets within that annuity instead of tapping into your other assets. And when you get to the end of that phase, then you still have the standard lifetime income to fall back on. So it's a great way to utilize and leverage that annuity to help to cover those costs instead of draining other assets that you have.
That's that's pretty powerful, when you think about it, that while you're covering your baseline of income with the annuity, you still have this multiplier kind of as a feather in your cap that can be leveraged down the road if you qualify. But we keep using that word qualify, Matt. Can you explain to our audience, like, what in these fixed indexed annuities with enhanced income benefit riders, what would someone have to have or be going through in order to qualify for that benefit? And if you could give us some insight on what's required from the carrier perspective in order to process that enhanced income or that doubler or multiplier of benefit.
Sure, great question. So the trigger for most of those annuities would either be if you were unable to perform 2 of 6 activities of daily living, or if you are confined to a qualified care facility. So that could be a hospital, a nursing home, some sort of a qualified care facility. Those are usually the 2 triggers for that benefit. And you would have to be certified by a physician. And so each carrier, as far as what documentation they require, could be a bit different. But in general, when you have met one of those triggers for the specific period of time, they may have where the confinement needs to last for 90 days consecutively, something to that extent, and you're certified, then that would activate that enhanced payout. A lot of the annuities also require that there has to be a value in the account to start that enhanced payout, and you would need to be recertified each year to continue receiving that. So if you recover, it would just drop back down to the standard lifetime income amount.
Okay, that's huge. So 2 things there I want to call out. So for those that are new to this subject matter and you hear the 2 out of 6 activities of daily living, those are going to be things like eating, feeding yourself, continence, walking, talking, and getting up and out of bed. So being able to move on your own. So those, as long as you qualify and are unable to perform 2 out of that list of 6, then that would be one of the trigger points or requirements that are met for this enhanced income benefit. In addition to that, Matt mentioned the attending physician statement. So obviously they're going to write a letter to the insurance provider to let them know of the documented, disabilities, if you will, 2 out of 6 activities of daily living and unable to perform those. And then there's a form that's required. So you're obviously going to have that form filled out. That'll go in with the attending physician statement. And then that carrier will process that payment. Matt also mentioned a very important point that a majority of these indexed annuities with enhanced income benefit multipliers require there to be enough account balance in order to activate that benefit. Now, if you've watched previous episodes of the I Love Annuities podcast, we have mentioned that there are a few products that are starting to offer this enhanced income benefit without that requirement of having an account balance left at that time of election. So if you'd like to find out more about which products those are, we would be honored to provide that information to you. You can visit our website to get started on requesting a free report by going to annuityassociation.com, and we'll get that free report out to you. Or if you just want to speak directly to an advisor, there'll be a link in the show notes here where we can get you on the calendar with a subject matter expert like Matt here, so that they can shed light on which products you should be considering if you're starting to explore these for long-term care.
And one point I want to bring up, and Matt, if you could speak to this, just when we look at long-term care, oftentimes what we consider is there's some type of physical associated with that. So when we're looking at a fixed index annuity with an income rider, and it has that component built into it where we have the enhanced income rider, is there anything that we need to consider there with the physical to be able to utilize this feature?
No, so other than as far as activating it, we discussed what would be needed to start that enhanced benefit. But as far as when you're applying for these annuities, there is not a medical questionnaire or physical or traditional underwriting that would be needed. There are some carriers that may say if you are confined when you actually purchase the annuity, that you may not qualify for that enhanced benefit at that point. But if the owner is in good health when they purchase the annuity, there's no requirements in terms of underwriting or medical questionnaires or anything like that.
Got it.
That's a good question there, Zach. I think that's a good call out too, to kind of highlight the person that may have already a health challenged medical history, where they have had maybe some ailments or some chronic diseases and things that would otherwise knock them out of qualifying for traditional long-term care insurance. That's the real benefit of these products here that we're discussing with the fixed indexed annuities, is that there are no health requirements in terms of having to go through any extensive underwriting. Actually, as a matter of fact, there's zero medical underwriting. There's only, I think, 2 knockout questions on the application. One of those will be, are you currently residing in a nursing home? Yes or no. If you answer no, then you qualify for this product. And the second question would be, have you been diagnosed with a terminal illness within the last 12 months? Yes or no. And as long as you answer no to both of those, you will qualify for this product with that enhancement. And I've had people come for that specific reason because they were knocked out of the traditional long-term care insurance plans, and they were looking for alternatives because they had either no family to fall back on and help take care of them when they need it. So a lot of times they have no children or any next of kin. And so they know that at some point they are going to need this type of planning and this type of care. And so this is a viable product for them that can give them the peace of mind and really the economic benefit of making their money go farther. It's stretching that out. I've actually had people buy these annuities that we're talking about, the fixed indexed annuity with long-term care enhancements. I've had them buy those products just for long-term care. In other words, they're never going to use it just for guaranteed income in retirement. They already have their retirement solidified, their retirement income solidified. What they are using this product for is for that specific reason of long-term care. So they never touch it until they need it. And then again, if they don't ever need it or they pass away, there would be a death benefit that passes on, which is the full account value at that time. So I think really knowing that if you have health challenges and you know that you're not going to qualify, or maybe you've been declined in the past for traditional long-term care insurance, this is a very suitable and viable solution to help you get that peace of mind and give you that stretch in those dollars to help you cover those increased costs that may come down the road.
Yep.
All right, so we've covered the fixed indexed annuity with the long-term care riders. Awesome job there, guys. We're going to move on to looking at some specific annuities that are more, I guess, specifically designed around long-term care. In other words, they're more focused on serving the long-term care aspect specifically. So they're kind of structured a bit differently than the fixed indexed annuity, but they will have some characteristics that are similar. So the first product we're going to talk about today on this segment is going to be one offered by OneAmerica. They are a leader in formalized long-term care annuity products. Matt, would you mind explaining the annuity care and asset care product line from OneAmerica?
Absolutely. OneAmerica, they offer two flagship products. The first is their annuity care, and that product is a fixed annuity, and it provides tax deferred growth so that the money is in an account, it's earning a rate of interest, but it also includes a long-term care benefits. So the unique feature with that particular product is that it offers a long-term care rider, and that can extend the coverage as far as those long-term care payments beyond just the value within the annuity. So it's giving you a multiple of that account for qualified long-term care expense. But if the long-term care is not needed, you still have the money in this protected annuity earning a fixed interest rate, which could serve either if you were to pull the money out at a future time, once you get past that initial term, or potentially a death benefit for loved ones. And so that would be their first product. The second flagship product they have is called Asset Care. And that is a hybrid product. It combines a whole life insurance with the long-term care benefits. So that would be for someone that they really want the sort of the framework of a traditional long-term care policy, but they don't want the use it or lose it approach, right? They want to know that if they did not use those long-term care benefits, that there would be a death benefit going to their heirs at some point in time. And so this particular product combines both of those elements, the whole life insurance with the long-term care. And they also offer an annuity funded version for that product. So that would be for someone that maybe wanted to reposition qualified assets. And another piece that's unique about that particular product, the Asset Care, is that they offer lifetime long-term care payments. So a lot of those hybrid options may limit to a certain number of years that someone could receive those long-term care payments, but the Asset Care has lifetime payments available. And so it's tax-free as long as the payments are used for long-term care benefits. If it's not used, there's a death benefit for the beneficiaries, and it's really the ability to leverage one asset for a couple different needs.
You had mentioned something about qualified money. So just so that I can understand a little bit better about what monies can be used for these policies, is that non-qualified or qualified?
So typically it would be non-qualified money going into these products, but the Asset Care has an annuity funded version that can be used to position qualified money into that product. And the way that it would work, so qualified money is not able to go directly in these types of products. What OneAmerica would do is essentially they would take that qualified money and it would go into a immediate annuity, so to speak, and it would pay in to that Asset Care over time to fund it. So as the money is coming out of the qualified account, it would be essentially converted into non-qualified.
Got it. Very cool. So really what we're optimizing here in the planning is we're taking an approach of just, instead of having idle assets that are doing nothing in my savings account, maybe earning me very little interest, if any at all, we're turning this into a different approach of the ability to grow my asset and income and long-term care protection.
Yeah,
Right.
that's true. Yeah, and the other thing too is, like, maybe some people are wondering, like, what assets should you currently consider maybe putting into something like this? And we really believe in the Maslow's retirement hierarchy. That's we've taken the hierarchy of human beings and their needs and kind of translated that over to the retirement needs. And so if you look at Maslow's pyramid, that foundation is income. So you should, once you have income taken care of, so guaranteed income to cover all of your lifestyle expenses, once you've gotten that foundation under you, then you obviously have your growth bucket, which is going to be, different vehicles like your market accounts and other investments like that. And then you should have that long-term care in place after those bottom two pillars or stacks of the pyramid are solidified. But sometimes, people will have like a random old 401k or an IRA or something that they just don't even pay attention to. And those are great solutions to just reposition those assets into these types of vehicles. I like the annuity care product. That's one that I'm pretty familiar with. And in addition to the asset care, and the annuity care is great because it's going to give you a multiplier on your benefit. So whatever monies you put into that product, let's say you put in 100,000, depending on what you qualify for, because there is a bit more qualification in this type of product versus the indexed annuity with the enhanced income benefit rider. Depending on what you qualify for, you are going to have either a 2 or 3x multiplier on those dollars to be used for long-term care needs. So if you put $100,000 in and you qualify for the 2x multiplier, that's going to give you a $200,000 benefit pool that can be used for long-term care. Same thing with that 3x multiplier, that 100,000 would turn into 300,000. Now, that pool is specifically used for long-term care only. So you can't cash it out and just take that benefit. If you die, that 200,000 or 300,000 would not be going to your beneficiaries. There is a separate account value that has that death benefit tied to it that would pass on if you died and never used this product for long-term care. But knowing that you can put a multiplier on those funds that you just maybe have randomly sitting in a random 401k or IRA, it's a great way to reposition that unused asset and give it more specific intended purpose to help solidify your overall retirement plan.
Yeah, I mean, we talk about today how I think the common conversation that we hear maybe too often is inflation and what that cost might be for somebody to take care of themselves, or what that expense might be, whether that's receiving care at home or an assisted living facility. I know we had talked earlier just about what that cost might look like, and there's even a website that we could use as a resource.
Yeah, let me go ahead and get that pulled up too. That's a good call out.
Yeah.
So, the costs are in this type of care, they're going to be very high at times, especially considering that healthcare costs grow at a faster pace than general inflation. If your general inflation is around 2 to 3% historically, healthcare costs have inflated around 4 to 5%. It's pretty alarming when you think about it. I just had like an accident a few months back where I was trimming an oak tree and I fell off the ladder and I busted myself up pretty good, and the limb ended up falling on me, which was a lot of fun. And I ended up having to go to the ER, which I didn't want to do, but apparently I had a concussion, and like when you looked in my eyes, like one pupil was bigger than the other and the whole nine. So I went and I said, "Hey, I just want to get checked out. I don't want any special treatment. Just do a scan or whatever you need to do to make sure that I don't have anything wrong with my head and, a brain bleed or something." And long story short, I asked for the minimum, service because I knew it was going to be costly. And a few months later, I got the bill and it was like $8,000 just for one trip to the ER. I was in there for less than an hour.
Yeah.
And, it just goes to show you our medical system needs revamping in a lot of ways, but the long-term care cost can be very costly. So let's take a look at the tool that we're using. This is offered by our friends at carescout.com. This used to be the original Genworth website. I'm trying to share this with you. Window, Chrome tab, cost of care. Here we go. Can you guys see this?
Yep, you're good.
Okay. So when you come to carescout.com, it's carescout.com/cost-of-care. And you can put in your location. So we're in Stuart, Florida. That's where our headquarters is here for Annuity Association. Once you input your destination or wherever area you're trying to find the cost, you can run the cost by hourly, daily, monthly, or annual. We're going to look at it from a monthly perspective. And then what I really find interesting is that you can forecast, like calculate the future cost of that care and give it an inflation adjustment if you wish. So let's look at it at a 4% inflation adjustment. And let's assume that you're maybe 70 years old today, and you've got some longevity on your side. Your parents lived into their 90s, or at least one of them did, and you're anticipating living a long life, but you know that as you advance in age, you're going to have some challenges down the road with health, and you're going to need some assistance, maybe from a long-term care perspective. So if we were to project this future cost, we can move this slider bar out to 2044. So that would be 20 years roughly. I guess it'd be 2045. This is going 2024 to 2044. Okay, 2024 to 2044. So 20 years. And then it's going to break down the monthly median cost for your area. So it's showing Port St. Lucie, which is the more popular town here, just outside of Stuart. And it's going to break down the in-home care cost, the community and assisted living cost, and the nursing home care cost. So it's going to show you that cost in today's numbers, and then show you the cost in 2044 or 20 years from now. So as you'll see, the nursing home care is very, very costly. Today, it's looking at a semi-private room at $14,935 a month. In 2044, that same semi-private room is going to be $32,724 a month. So it's definitely important to have a plan to cover it. It's just about finding the strategic way to do it and most optimal approach after you've addressed the other fundamental parts of your retirement plan.
Yeah, great tool. And I think you'll probably have that accessible in the link that we have on the show notes.
Yeah, we'll include it in the show notes or description wherever you're watching this episode. So with that being said, anything else you want to add there, Matt, to the OneAmerica product suite?
No, that's all I had as far as those two options.
All right, great. So let's discuss another big player in this space. It's another product that's competing with OneAmerica, and this product is called the ForeCare Annuity, which is offered by Global Atlantic. Matt, could you tell us what really stands out with the ForeCare Annuity from Global Atlantic?
Yeah, so the ForeCare is another fixed annuity that's designed specifically for long-term care planning. And what sets it apart is that it's a single premium deferred annuity, a fixed annuity. So the funds go into this account and they have the opportunity to earn interest based on a fixed interest rate. And with this annuity, based on that investment, depending on the level that an owner would qualify for, they would receive either 2 times their initial investment or 3 times the initial investment as a pool that can be used for long-term care income. And so if that long-term care is needed, then those payments can be drawn off of that pool. But if it's not, the money is still in the account and it's earning a fixed interest rate, which could either be cashed out after the initial term, or God forbid that owner passes, then that money would go to their heirs. And as that's used, if the income is used for long-term care need, the long-term care benefits are tax-free. The other piece that's unique is that there's no full underwriting for the base annuity. It's only a simple health questionnaire for the long-term care rider. So it's not as involved as the process to qualify for some of the other options out there. And it really gives the clients a lot of flexibility to either access the enhanced income for a long-term care need, or just to have their money growing with a guaranteed interest rate.
Got it. So really with the concept of this, if I invest 100,000 day one and need long-term care based on that health questionnaire that I fill out, I would have either 200,000 or 300,000 available as an enhanced income payment or a bucket that I could use.
Exactly. So the qualifications, the levels would be standard for the 2X or premier for the 3X. And so based on that scenario, if you put 100,000 in and you're approved for the standard qualification, you would have a pool of 200,000 to work with to be able to draw long-term care payments off of. Or as far as the premier, that would give you 300,000. Now, one additional detail is that the account is earning interest. So that 2X or 3X, they recast that each year based on where your account is. So if the account is just growing based on the interest rate, then that can actually increase that benefit pool. So it's one way that it can hedge against inflation, especially if you have that contract for a long time before it's needed, that benefit pool is increasing.
Okay, so as an example, we're 3 years into this policy. I haven't used an enhancement. My initial investment is $100,000, and I've earned 5,000 in interest. How does that affect the value?
So in that case, if let's say that the account value is now 105,000, so now the benefit pool for the standard would be 210,000.
I see.
So it would be double what's actually in that account. So they'll look at that each year and recast that benefit pool based on the net increase to your account.
Got it. Thank you.
My pleasure.
Got it. So I have an example of an illustration here offered by Global Atlantic for this specific product, and I ran it based on myself. I obviously used a different age, but here it highlights the benefits of that double or triple multiplier. Obviously, the 2X is that ForeCare standard approval, and then the 3X is the premier approval, which Matt was just speaking about. But what's really interesting about this illustration is that it breaks down the time frame that you would need to earn that same pool of money. So because we're getting a 3X multiplier in this case, I put in 100,000, I'm getting a $300,000 benefit pool for long-term care. They let you run assumptions to see how long it would take to earn that 300,000 in other types of investments. So I used some conservative figures, assuming that this person would not be willing to take a lot of risk with this money. So I put in that a taxable rate of return assumption would be just earning 2%. And then the tax deferred rate of return they'd be earning 5% a year annually. What's interesting is ForeCare, they're showing, obviously because of the multiplier, that we get that $300,000 benefit pool day one if we qualify for Premier. Earning just a 2% taxable rate of return, it would take 22 years for that 100,000 to equal 300,000. And then on the taxable side, tax deferred investment, it would take 22 years. So at age 82, that person would then have 300K. And then on the taxable investment, which would be something like a bank CD or something you're using just to earn a modest rate of return with no risk, it would literally take 70 years to equal 300,000. So it shows you the benefit of having a product like this that can give you that multiplier if you qualify for that long-term care pool to grow and be used for that benefit specifically for that need. So a very cool product, definitely something that people should be considering. And I think it comes down to the fact that maybe many people don't know that these products exist. And that's really the point of this podcast episode, is to shed light that there are specific annuity products out there that can be leveraged for long-term care needs in the future.
Yeah, I think you hit on a key point there. And really, we've shared 3 products out there, 2 with OneAmerica and 1 here with Global Atlantic, and these aren't the only ones that are out there.
For sure. All right. Where are we at? So, Matt, anything else that you feel like we should cover on Global Atlantic's ForeCare product?
So just that particular product. So it would be what's called an asset-based long-term care solution. And a scenario where that would come into play is maybe someone has money that's just sitting idle, that they're looking to earn some interest on it, but they also they have concerns about a long-term care need. So with a product like that, it's a vehicle where the money is in an account and it's earning interest. So it's that same setup as if someone were in a money market or some of those fixed interest options, but it also has the leverage for long-term care. So it's really a way to reposition perhaps non-qualified money that's just been idle and have that leverage so that it can assist with that long-term care planning as well, getting a couple different purposes out of that set investment.
I think that's really smart. You're kind of killing two birds with one stone there, repositioning that asset, still getting that conservative fixed rate of return on the general account value. But if you have that need for long-term care, you know that you're getting that multiplier, which is where the real value comes. I mean, for me, it's kind of almost a no-brainer, right? Like, why wouldn't you do that? If you've got plenty of money or a fair amount of money, rather sitting in a bank CD or a money market account, why wouldn't you reposition that asset, still get that same benefit that the money market or CD was offering you, but you're getting far more future benefit potential on a guaranteed basis? I think that's a no-brainer. I think many people would agree with that.
Absolutely.
And that still leaves the death benefit there too, right? So the big scary misnomer that we hear oftentimes is that you put your money in an annuity, you lose all of it. Well, again, here's a proven fact that we still have a death benefit remaining available if that's not used.
Correct.
Absolutely. Yeah. Now, Matt, can you tell us what are the gotchas in these products, man? I know people out there, especially all the annuity bashers and whatnot, they're going to try to comment on these and make some stuff up. What are the gotchas? Are there any things here that a consumer should know or be aware of? Are there any hidden fees, or are there any just things that aren't good?
So we talked about a few different options out there. We talked about fixed index annuities with the lifetime income and the enhanced long-term care payout. We talked about asset-based solutions from OneAmerica and Global Atlantic. And we also talked about a hybrid between whole life and the long-term care coverage. So in terms of the fixed index annuities, those enhanced payouts are often available without any additional fees. Some of the others will have a rider fee associated with them for that long-term care benefit. And so that would be one piece of it, as far as there will be a cost for that long-term care. But of course, when you balance it to what's the cost of not having a plan, it pales in comparison. The other piece to it is that some of these may have limited liquidity to some extent. So something like the Global Atlantic ForeCare will have a 9-year surrender period where they do allow withdrawal capability if someone needed to access their money and just take withdrawals here or there. But as far as completely canceling the contract, there is some restriction on the liquidity during that term. So as far as it being a gotcha, I wouldn't classify it as that, but there are some things to consider in terms of liquidity and the costs of these products.
Yeah, I'm looking at the ForeCare product. It does have a 10% free withdrawal that can be taken each year. There is a 9-year, like you said, surrender schedule. So after 9 years, if you want to walk away and cash out, you can cash out that full account value with no penalty. I don't really see any gotchas either. I think that this is a pretty sound product, and like any other type of annuity product you're considering, I think it's important that it comes down to the proper planning. it's really about understanding your goals, your objectives, and then right fitting solutions like these products to address the specific objective. I think where people oftentimes get caught up in worry and making mistakes is when they're trying to leverage one type of tool or just a general like savings or market account to address all of these specific areas of retirement planning. So, when it comes down to the way we operate and the way we work with our clients and prospective clients, it's about putting your needs first, your best interest first, understanding what those needs and goals are, and then right fitting the solutions appropriately. So, if you have some money that you're looking to reposition, still get that fixed rate of return, also receive a multiplier for potential long-term care needs in the future. It's really a no-brainer. It doesn't really have to be much more complex than that. But if you're trying to, use an annuity for all of these other things, plus that, plus this, and all of those, things are trying to be covered with one product, that's not the right approach. And anybody that's telling you that one annuity can do it all, they're just blowing smoke up you know what. So it's something that you need to be wary of. But if it sounds too good to be true, it usually is. That's where you need to, make sure that you're working with an expert, someone that truly knows these products inside and out, and that they're independent, that they can, help you compare multiple products side by side and give you the education and transparency of how this product fits into the overall plan, to give you that peace of mind and that clarity that you're working with someone that knows what they're doing and can act and put your best interest in the position it needs to be when making these important decisions. And that's really what we're aligned to do here at Annuity Association. All right. Anything else there's after Matt?
No.
Yeah, I just want to add, one thing that we've talked about before, the value of an annuity with a lifetime income benefit, what it allows somebody to do and having those assets be more free to potentially grow in the market and maybe be a little bit more risky with their growth opportunity. I think this is another component that can add some value, and that somebody may have some concern around, okay, if I do have a long-term care expense, that's going to dip into that asset pool that I had planned on growing aggressively. And now I've got very little or less that I can leave as a legacy benefit to my kids or to my grandkids. And having a tool like this on the belt can really add a lot of value.
I couldn't agree more. I think also, we really didn't touch on the cons of not having a plan. Like if you don't have a plan for something like this, what is the impact to you and your family? That's what I always think about. I know with the people that really choose to work with our organization, they usually have a lot of things in common. One of them being that they don't want to become a burden to their loved ones. They don't want to become a financial liability to their loved ones, their children and their grandchildren. And I think that is important to note, because this is the type of product that can help you not, succumb to that potential reality. Having a plan in place, having the right products to fit those intended purposes and goals is really instrumental to having peace of mind, clarity, and confidence, but also knowing that regardless of what happens in the future, you're never going to have an issue or become a burden to somebody that you care about. So sometimes the legacy in itself is just making sure that you keep your dignity and that you have the plans in place so that no one ever has to be burdened by, your lack of planning. So I think that's huge, and it's something that we're passionate about. So if you're interested in working with a subject matter expert like Matt, or maybe Matt specifically, and you want to get his expert advice on how to position these products to optimize your plan for long-term care, you can visit our website at annuityassociation.com, or in the show notes or description of this episode, you can visit the unique link that's there to schedule your free annuity discovery meeting. It's a discovery meeting about your needs, your goals, and the things that matter most to you and your family. It's a no pressure, there's no shady sales tactics or anything. It's literally a conversation that we get on a Zoom meeting, talk about everything that's important to the situation, and then help you kind of determine whether or not an annuity is the right fit for that solution. Or if maybe you're not quite ready yet to speak with an advisor of our team, you can request a free annuity report where you can answer a questionnaire. It'll ask you some specific questions around what your intended purpose is for this money. And then we can send you out a report of the independent annuity marketplace to help you get some more clarity and transparency on the potential products that might suit you the best. We are an independent annuity advisor. We service clients in all 50 states. We leverage technology to bring the most up-to-date, transparent, and informative information about annuities on the marketplace today. We're proud of what we do. We're honored to serve you, and we would really, really be fortunate and blessed if we could have the opportunity to serve you specifically when it comes to your specific planning with annuities. So with that being said, this is another exciting episode of the I Love Annuities podcast. We are more than just the original duo of the Annuity Dudes. We are the triple, the trifecta of the Annuity Dudes. And that is that I am Jeremiah Conger.
I'm Zachary Van Ness.
I'm Matt Sluizer.
And we are the Annuity Dudes signing off. Thanks for watching.